today. I'm lucky enough to be talking to one of the true giants of modern financial theory. He's won a Nobel Prize for his work developing capital asset pricing model, otherwise known as CAPM, and people even have very popularly attached his name to a ratio that he worked on that is widely used for measuring risk-adjusted returns, the Sharpe ratio. He is, of course, Stanford University's Bill Sharpe.
I'm delighted to be here, and I should point out, as you suggested, others called it the Sharpe ratio. I called it the reward to variability ratio, which I still am somewhat enamored of, but
right, so
I'm happy to have my name
the Sharpe ratio might have been regarded as better branding. Now,
yes.
Now, in your recent career, you've focused a lot on retirement saving, and particularly on the very difficult issue of what people should do to fund their retirement once they've already retired. In the UK, we've had this fascinating new development where the compulsion to buy an annuity is being removed. Does that, in principle, sound like a good idea? What are the key problems that you see for planning for income in retirement?
Well, I was surprised as well when I read about that. It's a difficult issue. Ideally, people would know have all the information, be able to decide exactly how much to annuitize, how much to not annuitize. But we know people aren't always perfect decision makers. So at the very least, I think it's important to nudge people in directions that you think might be better for them by providing a default. And what we do know is that many people who are lower and middle income really are taking a big risk if they do not annuitize to some extent. Risk of basically running out of money. I'm not worried about the higher income people. They can probably choose to do so. So I would prefer, I suppose, to default people into an annuity and then make it possible for them to choose to take less of an annuity or none. And I'm not sure about how the new procedure works, but
you'd give them the freedom to do something stupid,
yeah,
but
I
you
think
would
so.
guide them strongly.
Try to guide them to understand what the trade-offs really are. I mean, we know from experience in the States, corporate plans where the option to annuitize is given, and it's presented in a fairly neutral way. Probably more people choose not to annuitize than perhaps is in their best interest.
So a strong nudge might be...
I would prefer to nudge with starting with an annuity and say, oh, by the way, you can reduce this or eliminate it. Here are some projections that might help you.
Now let's talk a bit about what the actual investments should be held in. You have been a strong proponent of passive investment, tracking indices rather than active management. Is that because the market is difficult to beat, or because it's best to minimize costs, or a combination of those things?
All of the above. The market is difficult to beat. Now, obviously, if you want a lower risk strategy, you need to do something like mix the market with some sort of bond portfolio. But the market's difficult to beat, and it is really important to lower fees. People very often make a cognitive error and say, well, it's only 1%, but it's 1% per year. And that adds up to alarming differences over a 30, 40-year period.
Now, one of the topics that's of great interest at this conference, one of the flavors of the moment, is something called smart beta, which might arguably be a slight violation of the way you use beta in your own research. But the idea of trying to reasonably passively have a screen for looking for particular factors of investment and keeping costs as low as you can. Is that a sensible addition to the armory? Does it make sense?
Well, the way I look at it, there are two aspects of the decision. One is, should you in person, tilt your portfolio towards, I don't know, value stocks or small stocks, whatever it may be. If the answer to that is yes, then I would certainly advocate doing it as cheaply as possible. And something like a low-cost index fund that tilts in some mechanical way in that direction would be the way to go. The bigger question is that a good idea for you? If the vendor is saying, this is a good idea for everybody, then that's a view that holds that there's something wrong with the markets.
Right.
But if the argument is, well, it's good for you, but it's better for so-and-so to tilt the other way, then at least I would pay more attention to the argument.
Right.
But if it's just the markets are crazy and they always undervalue these stocks and always overvalue those stocks, and we can take advantage of the dumb people in the market, I find that a less persuasive argument. Might have worked in the past.
But it has the seeds of its own destruction, doesn't
yes,
it?
well,
They'll eventually correct that anomaly.
Exactly. I mean, if something, you can always find something that would have worked in the past if you torture the data long enough and hard enough. The question is, will it work in the future? And I think there you should be skeptical.
Okay, now one final question I'd like to ask, because again, it continues to dominate discussion at this conference and other financial conferences. We're still living in the aftermath of the crisis of 2008. One of the more popular culprits is to say that the financial models that people were using were too simple. I suppose the one that gets mentioned most often is the value at risk model for assessing day-by-day risk. Do you think that it is true that the models such as CAPM that you were part of building have been used too simplistically, were part of the problem?
Well, models such as the CAPM and other models of that sort are simple.
Right.
They have to be simple or else they wouldn't be models.
Okay, and they have the word ceteris paribus.
That's right. And in practice, all those techniques, portfolio theory techniques, value at risk, involve someone making assessments of the possible range of future outcomes. And that someone is almost of necessity somebody in the industry.
Right.
The academics don't do that. So I think it's important sometimes to differentiate between the model being useless and the particular probabilistic, if I can use that term,
right,
forecasts being erroneous. And a very famous philosopher, a baseball manager in the States once said, predicting the future is really hard. I'm sorry, I blew that.
Right.
Making predictions, let's see. Yeah, I'll get it right. Making predictions is really hard, especially about the future.
Right.
So I think it's impossible for anybody to predict exactly what's going to happen in the financial markets. But we do try to get along, people in the industry do, making predictions about the range. And maybe those predictions are wrong as well. I think in the 2007-9 period they were. Value at risk is a particular part of a whole range of possible things that could happen. And I think it's, in general, too simplistic a measure, even if you, quote, get it right.
Okay, Mr. Sharpe, it's been a privilege. Thank you very much indeed. I hope that was a useful, if rather shallow and rather swift, glimpse into some wide and fascinating areas of discovery. Let's just remember, models are very useful, but at the end of the day, they are only models.